I don't use banks anymore. I became my own bank. And I used my bank's money to buy 2 rental properties. Sounds crazy, right? But it's real. I'm about to walk you through a financial strategy that feels like a cheat code, combining whole life insurance and real estate investing into a system that gives you control, liquidity, and long-term wealth. This is the infinite banking concept, IBC, and once you understand it, you'll never look at money the same way again. What is infinite banking? The elevator pitch infinite banking is a strategy where you use a specially designed whole life insurance policy to create your own private banking system. Instead of borrowing from traditional banks, you borrow from yourself, using the cash value inside your policy. It's like having a personal line of credit that grows while you use it. The origin story. The concept was popularized by R. Nelson Nash in his book Becoming Your Own Banker. Nash was a financial advisor who realized that whole life insurance policies could be used not just for death benefits, but as a powerful tool for financing. He saw that the cash value inside these policies could be borrowed against, and that the interest paid on those loans could be recaptured, essentially allowing you to be your own bank, whole life insurance as a financing tool. What is whole life insurance? Whole life insurance is a type of permanent life insurance that lasts your entire life and includes a savings component called cash value. Unlike term life insurance, which only provides a death benefit, whole life builds equity over time. Key features: guaranteed death benefit. Your beneficiaries receive a payout when you die. Fixed premiums. Your payments stay the same. Cash value accumulation. A portion of your premium goes into a savings account that grows over time. Dividends. If you use a mutual insurance company, you may receive annual dividends. Why it works for infinite banking. Liquidity. You can borrow against your cash value at any time. Control. You decide when and how to repay the loan. Privacy. No credit checks or loan applications. Uninterrupted growth. Your cash value continues to grow even while you borrow against it. My personal policy, the numbers. Let's get into the real numbers. I started my policy 3 years ago. Here's how it's structured. Annual premium, $30,000. Cash value after year 1, $22,000. Cash value after year 3, $75,000. Loan taken, $50,000. I borrowed $50K from my policy to invest in real estate. No bank involved. No paperwork. Just a phone call to my insurance company. The real estate I bought. Property #1, the ugly duckling. Purchase price, $120,000. Down payment from policy loan, $25,000. Renovation, $30,000. ARV, after repair value, $200,000. Monthly rent, $1, $800. This property cash flows and appreciated significantly. The kicker? I still earn dividends and interest on the $25K I borrowed. Property #2, the turnkey gem. Purchase price, $150,000. Down payment from policy loan, $25,000, no renovation needed. Monthly rent, $1, $500. This one was plug and play. I used my policy loan to secure it fast, beating out other buyers who needed bank financing. The math behind the magic. Let's say your policy earns 5% annually in dividends and interest. You borrow $50K at 4% interest. Meanwhile, you invest that $50K in a property earning 12% ROI. You're earning 5% on the full $50K inside your policy. You're paying 4% interest on the loan. You're earning 12% on the real estate. Your dollar is working in 2 places, and you're netting a positive spread. Why is this strategy so controversial? Criticism #1. Whole life insurance is expensive. Yes, it costs more than term insurance. But you're not just buying insurance, you're building a financial system. Criticism #2. It takes time to build cash value. True. It's not a get-rich-quick scheme. But once it's built, it's a lifelong asset. Criticism #3. You're paying interest to yourself. Kind of. You pay interest to the insurance company, but your cash value keeps growing. So you're earning while you borrow. Criticism #4. Complexity. It's not simple. You need the right policy, the right structure, and the right mindset. But once you get it, it's game-changing. Deep dive how cash value loans work. When you borrow against your policy, you're not withdrawing money. You're using your cash value as collateral. The insurance company gives you a loan, and your cash value continues to earn dividends and interest. It's like taking a home equity loan, but your home is your life insurance policy. How to structure your policy for infinite banking. Use a mutual insurance company. Mutual companies are owned by policyholders, not shareholders. That means they pay dividends to you, not Wall Street. Add a paid-up additions, PUA rider. This rider allows you to add extra money to your policy, which goes straight to cash value. It supercharges your growth. Work with an IBC certified advisor. Not all insurance agents understand infinite banking. Find someone who specializes in it. Case studies beyond me. Case study #1. Business owner. A small business owner used IBC to fund inventory purchases. Instead of using a line of credit, he borrowed from his policy and repaid it with profits. Case study #2. College funding. A couple used their policy to pay for their child's college tuition. No FAFSA. No student loans. Just a policy loan. Case study #3. Emergency fund. One family used their policy as an emergency fund. When their car broke down, they borrowed $10K from their policy and repaid it over time. Getting started, your first steps. 1. Learn the basics. Read Becoming Your Own Banker by Nelson Nash. 2. Find a mutual insurance company. Look for companies like Mass Mutual, Guardian, or Lafayette Life. 3. Work with a specialist. Find an advisor who understands IBC. 4. Design your policy. Make sure it's optimized for cash value, not just death benefit. 5. Fund it consistently. Treat it like your personal bank. 6. Borrow strategically. Use loans for investments, not consumption. 7. Track your growth. Monitor your cash value and loan balance. Glossary of key terms. Cash value, the savings component of a whole life policy. Paid-up additions, PUA, extra premiums that go directly to cash value. Mutual insurance company, a company owned by policyholders. Policy loan, a loan taken against your cash value. Death benefit, the payout your beneficiaries receive. Dividend, a share of the company's profits paid to policyholders. Turning this into a YouTube video. Visual breakdown. Use animations to explain IBC simply. Show your policy dashboard and loan process. Tour the properties you bought. Include charts showing cash flow and ROI. Add a segment on criticisms to build trust. Thumbnail tips. Your face with a shocked expression. Big text, $50,000 secret, or banks hate this. Split image, ugly house versus renovated one. Final thoughts, why I'll never use a bank again. Infinite banking isn't for everyone. But for those who understand it, it's a powerful tool for financial independence. I've used it to buy real estate, fund investments, and build wealth, all without relying on traditional banks. If you're tired of being at the mercy of lenders, this strategy might just be your way out. Call to action. If this blew your mind, imagine what it could do for your finances. Start learning. Start building. And start banking on yourself.